What if million-dollar homes in New York suddenly lost 20% of their value in just 2 years? Right now, the city's median price is at a record high, but affordability has never been worse, and national forecasts are signaling stagnation ahead. Beneath the headlines, 3 silent cracks are spreading. And in 2026, one trigger could bring it all crashing down. Think you know why New York home prices could finally fall? The truth is far messier, and it could hit closer to home than anyone expects. New York City's housing market has never looked more expensive or more precarious. The median listing price now stands just above $1 million, a threshold that once sounded unthinkable for a citywide average. This isn't just a Manhattan phenomenon. Borough after borough, prices have climbed relentlessly since the pandemic, with Brooklyn and Queens both posting double-digit gains between 2021 and 2024. Even as the rest of the country cooled, New York's numbers kept rising, pushing affordability to the breaking point. For buyers, the math has become punishing. Mortgage rates, which hovered below 4% just a few years ago, now sit between 6.4% and 7%. That means the monthly payment for a median-priced home has doubled since 2020, while wages in the city have barely budged. The result, more families are priced out than ever before. The homeownership rate in New York remains well below the national average, and a growing share of mortgage applicants are being rejected due to debt-to-income limits. In some neighborhoods, the gap between what people earn and what homes cost has never been wider. National forecasts offer little comfort. Zillow now projects that New York City's home prices will slip by just over 1% through May 2026, putting the city among a handful of major metros expected to see outright declines. While markets like Rochester and Syracuse are forecast to grow by 2% or more, New York's price curve has flattened. The city's once unstoppable momentum has slowed to a crawl. Sellers are already feeling the impact. Listings linger longer, and price cuts are becoming more common, especially in the luxury segment. Some properties now sit on the market for 90 days or more without a single offer, a far cry from the bidding wars of just 2 years ago. Inventory tells its own story. After a surge of new listings in early 2024, the pace has cooled. But luxury condos and new developments in Midtown and downtown are increasingly sitting unsold. In the past, these units would have been snapped up by foreign investors or corporate buyers, but that demand has thinned. With more units competing for fewer buyers, the city's price ceiling looks less stable than ever. The numbers are clear. New York's housing market is stretched to its limits. Prices remain at historic highs, but the forces that once fueled endless growth, cheap money, global demand, and a sense of urgency among buyers are all fading. The city is now balanced on a knife's edge, with affordability at record lows and forecasts pointing to stagnation or even decline. The question isn't whether the market can keep climbing, but how long it can hold this ground before something gives. A brownstone in Crown Heights hits the market in early spring. The seller, a school principal, lists at $1.2 million. Right in line with the neighborhood's recent sales. For the first month, the only calls come from agents fishing for listings. By week 6, a single couple tours the property, but they never follow up. The listing sits. After 90 days, the owner faces a choice: drop the price or pull the home off the market and wait for better days. She chooses to lower it, shaving $75,000 off the asking price. Still, nothing. This isn't just a story about one house. It's a signal. In 2021 and 2022, listings like this would have sparked bidding wars. Now, hesitation is everywhere. Buyers run the numbers and walk away. The city's affordability index, which tracks the gap between wages and home prices, has surged to its worst reading in decades. For a median-priced home in New York, the monthly payment now swallows more than 60% of the average household's take-home pay. That's nearly double the share from just 5 years ago. The emotional math is changing. For years, fear of missing out drove buyers to stretch, to compromise, to leap before they were ready. Now, the fear is different. It's the fear of getting stuck, of buying at the top and watching values slip. Agents whisper about phantom listings, homes quietly pulled from the market when sellers refuse to cut their price, hoping next year will be better. But the standoff is everywhere. Sellers anchored to yesterday's highs, buyers haunted by the possibility of tomorrow's lows. The principal story echoes across the city. In Astoria, a two-bedroom condo lingers for 110 days before the owner gives up and finds a tenant instead. In Bay Ridge, a family hoping to trade up faces a market where their own home won't budge, even after 2 price cuts. Each failed sale adds to the sense of unease. For many, the dream of homeownership in New York now feels fragile, no longer a sure path upward, but a risk with real downside. The market's confidence has cracked. What was once a race to buy has become a waiting game, with sellers and buyers both looking for a sign that it's safe to move. The next chapter won't be written by headlines or averages, but by thousands of these quiet, anxious decisions. One price cut, one withdrawn listing, one missed opportunity at a time. A new skyscraper was supposed to rise at 525th Avenue, a symbol of Midtown's next chapter. But in 2024, the developer quietly pressed pause. Planning board filings cited spiraling costs and doubts about whether enough buyers would materialize. Behind the scenes, lenders grew anxious. Project decks began referencing a possible multi-year sales backlog. Units that could sit empty, draining cash if the market didn't recover. This isn't an isolated case. Across Manhattan and the outer boroughs, dozens of planned condo towers have been shelved or converted to rentals before ever breaking ground. New launches in Manhattan dropped 35% year over year by mid-2025. The city's pipeline of new units is shrinking, but the backlog of unsold inventory is quietly piling up. Sponsor-held units, condos still owned by developers, numbered 4,400 in early 2025, down from the pandemic's peak, but still far above what the market can easily absorb. In some marquee towers, 10 to 20% of units are being rented out temporarily, masked as shadow inventory, to manage cash flow until buyers return. This tactic buys time, but it also hides the true number of homes waiting to hit the market. In Midtown, high-end towers like 157 and 432 Park have seen unsold units linger for months, sometimes years, especially those priced for foreign buyers who have largely disappeared. The financial pressure is mounting. Most construction and bridge loans taken out in the 2021 to 2022 boom will come due in 2026 and 2027. Lenders are already tightening terms, demanding faster sell-through or principal paydowns. For projects stuck below 60% sold after 2 years, the threat of bulk sales or forced listings looms. If rates stay high and buyers remain scarce, thousands of sponsor-owned condos could flood the market at once, especially in Midtown and the outer boroughs. The city's supply problem isn't just about homes being built, it's about homes that exist but can't seem to find an owner. Mortgage rates in New York now hover between 6.4% and 7%, a level that has quietly redrawn the boundaries of who can buy a home. In 2020, a typical family seeking a median-priced apartment faced a monthly payment of about $3,000. That same apartment now demands more than $6,000 each month, before taxes, insurance, or co-op fees. The numbers are simple, but the consequences are not. With city wages barely moving, most working households are locked out. The city's debt-to-income rules, designed to prevent overreach, now turn away more applicants than ever. In 2025, denial rates on mortgage applications in New York reached their highest level in over a decade, with more than 1 in 3 would-be buyers rejected for exceeding safe borrowing limits. For many, the only option is to rent. The homeownership rate in New York sits below 32%, far below the national average. Each year, the gap widens as more families abandon the idea of buying altogether. Even among those who qualify, the financial stretch is punishing. A household earning the city's median income would need to spend over 60% of take-home pay just to cover a typical mortgage and taxes. That's nearly double the share considered affordable by federal standards. The effect ripples outward. Fewer buyers means less competition for sellers. Listings that once drew multiple offers now sit for weeks, sometimes months, as buyers do the math and walk away. The city's pool of qualified purchasers continues to shrink, not because people want to rent, but because the cost of ownership has outpaced what most New Yorkers can earn. The housing ladder, once a symbol of upward mobility, now feels more like a wall. For thousands of families, the dream of owning in New York is no longer just delayed. It's slipping further out of reach with every rate hike and stagnant paycheck. Foreign money once seemed like a permanent fixture in New York's housing market. In 2018, Chinese buyers alone spent about $1.2 billion on city homes. By 2023, that figure had fallen to less than $600 million, a drop of more than 50%. The broader pool of international buyers has thinned as well, shrinking from 15% of Manhattan purchases in the late 2010s to just 7% of deals by 2024. The reasons are clear. Beijing's crackdown on capital outflows, U.S. sanctions, and tighter anti-money laundering rules have made it harder to move large sums across borders. Pandemic travel bans and rising global tensions only accelerated the retreat. The impact is visible at the top of the market. Towers like 157 and 432 Park, once magnets for foreign capital, now report growing numbers of unsold sponsor units. Building ledgers and brokerage records show a steady climb in luxury inventory, especially in condos priced for overseas buyers. In some cases, 10 to 20% of units are being quietly rented out, waiting for the next wave of investment that has yet to arrive. Corporate relocations, another pillar of high-end demand, are also fading. In 2019, more than 8,000 employees moved to New York with company support. By 2024, that number had dropped to around 5,600, a decline of nearly a third. The shift to hybrid work means fewer executives need a permanent address in Manhattan. Large firms now offer fewer full relocation packages, and corporate leased apartments in Midtown are posting higher vacancy rates and faster turnover. Office towers sit half empty, and the pipeline of well-paid buyers has narrowed with each passing year. What once seemed like an endless flow of global and corporate money has slowed to a trickle. The luxury segment, long insulated by outside demand, now faces a more uncertain future. With fewer investors and relocating professionals to pick up the slack, the market's foundation has quietly weakened, leaving high-end prices exposed to the next downturn. Adjustable rate mortgages written during the 2021 buying frenzy are about to reset. For thousands of New York homeowners, this means monthly payments will jump by 30 to 50% in a single year. In neighborhoods like Astoria and Forest Hills, the impact is already being felt. A multifamily landlord in Queens refinanced in late 2021, locking in a low teaser rate that kept the building afloat. Now, with the loan scheduled to reset in early 2026, his payment will rise from $7,200 to nearly $10,500 a month. Rent stabilization caps his income, but his costs are outpacing what tenants can pay. He's not alone. Bank risk memos reviewed in 2025 warn of a cluster of resets hitting Brooklyn and Queens at once, especially among buyers who stretch to enter the market with little equity. For some, the math no longer works. Owners unable to refinance or sell at a profit face tough choices, raise rents, sell at a loss, or risk delinquency. As reset notices arrive, the first wave of forced listings and fire sales could follow, driving up inventory just as demand thins. Payment shock isn't just a line on a spreadsheet, it's the moment when hope turns to anxiety and a household's future hangs on the next letter from the bank. The city's safety nets are starting to fray. New York's 421 tax abatement, a fixture for decades, expired in 2022. For years, this incentive kept new construction alive by slashing property taxes for developers who built rental housing. Since its lapse, building permits for new rentals have collapsed, down 78% in the 12 months following the program's end, according to the NYU Furman Center. The Independent Budget Office now projects that without a replacement, the number of multifamily rentals entering the market will fall by at least half through 2026. In the short term, developers are racing to finish projects that qualified under the old rules, briefly pushing more inventory onto the market. But that pipeline is almost dry. By 2026, the city faces a construction cliff, fewer new rentals, a shrinking supply of affordable units, and even more competition for what's left. Market stress tests from CoreLogic and others warn that if high rates persist and job losses mount, the city's most vulnerable segments, luxury condos in Midtown, new outer borough developments, could see prices slide 10 to 12%. In a severe downturn, that risk climbs closer to 20% for some pockets. Most mainstream forecasts remain steadier, with citywide projections flat to down just 2%. But the policy risk is real. Once the last 421A projects are absorbed, the city's ability to stabilize prices will depend on forces it can't control: interest rates, employment, and whether nervous owners decide to list all at once. Scarcity has always been New York's silent ally. The city's geography, bound by rivers carved up by zoning rules, means truly buildable land remains stubbornly limited. Even as new towers rise, the supply of homes grows only in small, hard-won increments. This constraint has helped shield values in past downturns, acting as a natural buffer when other markets saw sharper corrections. Another stabilizing force: owner equity. Decades of appreciation and tougher lending standards have left most homeowners with solid financial cushions. Unlike the speculative waves of the early 2000s, today's buyers have put more money down and carry less risky debt. Bank data from 2025 shows that more than 60% of city homeowners hold at least 30% equity in their properties, a margin that makes forced sales less likely, even if prices slip. Consensus among many economists remains cautious but not dire, while certain pockets, luxury condos, new developments in the outer boroughs, face exposure. The broader market is underpinned by these structural strengths. New York's history of weathering national storms, from the early 90s to 2008, lends weight to the argument that for all its volatility, the city rarely collapses the way others do. The buffers are real, even as risks gather on the horizon. In 2024, New York's median home listing crossed $1 million, marking the city's least affordable housing market in decades. This documentary traces how stagnant wages, 6 to 7% mortgage rates, and a 30% drop in corporate relocations have thinned buyer demand. Historical records show that when affordability collapses and supply builds, like during the early 90s and 2008, New York saw price declines of up to 20%. Today, paused projects such as 525th and a growing backlog of unsold luxury units echo those warning signs. Yet, with 43% average equity and land scarcity, some resilience remains. What happens if high rates and job losses persist through 2026 is still uncertain. No official forecast predicts the full scope of a correction, but the evidence points to real risk, not just rumor. For New Yorkers, the lesson is clear. When fundamentals weaken, even the strongest markets can shift quickly.